Hi, welcome to Company F, or Fast Footwear's presentation on the business strategy game.
This is Nicole Dale, and I will be discussing our corporate citizenship decisions. Fast Footwear learned in the second week that investing too much into our corporate citizenship was too expensive for our company and resulted in little return. The amount we were spending in year 12 did not generate the credit rating and image rating we were expecting. We decided to scale back on our corporate citizenship spending to bring our cost per pair down to 34 cents. We were also able to cut our spending down to $2,471,000 total expenditures. This helped cut our costs down to generate more revenue. Once we are generating higher profits, we will then be able to invest more into our corporate citizenship towards the end of the game.
Hi, this is Austin Christopher, and I'm going to discuss the sales forecast for Fast Footwear. In the first few years, we did a poor job finding the right mix of price, SQ rating, and production. As you can see, sales dropped dramatically for us in years 11 and 12, and much of this had to do with raising wholesale price but losing SQ rating. We were in essence charging more for a poorer product. We began to realize the mistake in year 13 and dropped wholesale price and internet price, which in turn helped boost the SQ rating. Because our rating rose, we were able to finally get our bids approved for private label operations, which has helped skyrocket sales and credit ratings.
Hi, this is Lynn Piper, and I'll be discussing our plant capacity and upgrades. In year 11, we wanted to get a lower reject rate in our North America plant to reduce costs. We invested in assembly line upgrades that lowered our cost per pair by 54 cents. In year 13, we built a plant facility in Latin America, increasing our overall capacity by 1.2 million pairs. We're currently utilizing plant capacity at our highest rate to date of 114%. This is slightly below the industry average of 115%. Hi, this is Lynn Piper, and I'll be discussing our brand and production. As Austin mentioned, we realized our quality was in serious need of improvement after year 12, as our North America plant had an SQ rating of 4 and Asia Pacific was at 3. This put us at a serious disadvantage in the market, so we took steps to significantly improve quality. In year 13, we increased spending on our Six Sigma quality program by $2.4 million, and in year 14, we increased our superior materials spending by roughly $13 million. These efforts have helped to boost our quality. Our total production cost per pair is now $21.91, which is $1.03 per pair less than year 10. Moving on to our branded distribution, Fast Footwear has done a poor job managing inventory levels each year, which has resulted in extremely high inventory storage costs. In year 15, we spent $3.4 million on inventory storage. We decided clearing inventory was required to cut these extra costs, but this did result in significant loss. In year 13, we made mistakes when assessing the impact of exchange rates and tariffs. In Europe, Africa, we spent almost $11.5 million on tariffs. These were hard lessons to learn, however, we've been working on these going forward.
Austin here again to discuss internet marketing. As you can see, we have generally kept about the same marketing budget each year. However, we have had huge fluctuations in online orders. We attribute our newfound success with internet marketing not on our advertising budget, but with our celebrity contract and adaptation of free shipping. In turn, our internet market share increased, and we are looking to have over 11% market share in all markets, with as high as 13% in Asia in year 16. As the years moved on, we have generally done a good job keeping costs low and using the internet and strategic marketing to increase our sales.
This is Nicole Dale, and I will be discussing our wholesale marketing strategy. Our first 2 years of wholesale price for the North American plant were over $50. We quickly found out that this was too expensive to be charging our wholesalers this much. Our strategy was to lower it to $40 by year 16 and become the best cost provider to our wholesalers. Our strategy is to offer the cheapest shoes to our wholesalers so they will want to sell our products over our competitors. We were also careful not to create channel conflict by bringing our internet price below wholesale price. If we would have done this, wholesalers would have seen this as trying to undermine them. We learned that while a quick delivery time may be appealing to our wholesalers, it is too expensive for us to push a 1-week delivery time. Instead, we decided that between 2 and 3 week delivery time is both reasonable for us to manage and for wholesalers to expect.
Hi, this is Lynn Piper, and I'll be discussing our celebrity endorsements. In years 12 and 13, our market share and image rating were well below investor expectations. To improve, we contracted with celebrity Ace Federer for a 1-year endorsement in year 14. Following this endorsement, our internet market share increased considerably in each region. However, we recognized that $10 million for a 1-year contract was not the best use of funds, and we may have benefited from having multiple lower-cost celebrity contracts to help maintain our sales and consumer appeal.
This is Nicole Dill, and I'll be discussing our private label operation decisions. We decided to wait until year 15 to invest into the private label operations. We also wanted to wait to ensure that we would be successful. Since we struggled with sales in the beginning of the years, we were hesitant to jump into private label operations. We were happy with the decision because we were able to sell 100% of what we offered in all of our plants. We were also able to establish a portion of market share before all companies had entered into this market. Our Europe-Africa plant has the highest market share while competing against 3 other companies. We learned that having above a 3 SKU rating and establishing the correct price, which has to be $5 below our wholesale price, is what is allowing us to be successful in private label. We will continue to adjust our prices and increase our SKU rating accordingly.
Austin here to talk about finance and cash flow. We found ourselves in debt shortly after beginning the game because we took out a loan in the hopes that it would boost our credit rating as we paid it off. To this regard, we weren't overly careful in the beginning and it cost us until we could right the ship. Now, we have figured out the right mix between wholesale and internet sales, and as revenue soar, we can pay off our outstanding debt and no longer have the highest debt-to-assets ratio or highest default risk ratio of all the companies. Some of our costs are necessary expenditures, though, such as charitable contributions and efficiency initiatives for our image rating. Overall, as time has gone on, we have been able to pay off debt while still maintaining a positive cash balance at the end of the year.